$78.55. That's where physical silver closed yesterday on the Shanghai Gold Exchange. December 24th, 2025. While COMEX futures in New York settled at $72.36, Shanghai Physical was trading $8.19 higher. An $8 premium for the same metal, same day, different markets. But that's not the shocking part. The shocking part is what that premium means. It means physical silver, actual deliverable metal, is worth $8 more in Asia than paper promises are worth in the West. It means the global silver market just fractured. Paper and physical are decoupled. And when that happens, when the world's largest consumer is paying massive premiums for immediate delivery while Western futures trade at discounts, history says we're not in a rally. We're in the early stages of a supply crisis. And we've seen this movie before. Act 3 of a 4-act play. Rome debased its currency until silver coins were 95% copper. Weimar printed until money was worthless. Nixon closed the gold window and precious metals exploded. Every time paper promises break, physical assets reprice. And Shanghai just told the world the paper market is breaking. Right now, in real time. And the banks thought sold promises they can't deliver. They're starting to panic. Let's start at the beginning. 270 AD, Rome. The empire is collapsing, but nobody wants to admit it. The denarius, their silver coin, started at 90% pure silver under Augustus. By the time Emperor Aurelian takes power in 270, it's 5%. 5% silver. 95% copper with a silver wash. They called it financial innovation, adjusting the monetary standard, optimizing supply. The Romans weren't stupid. They had advisors. They understood economics. They knew what they were doing would cause inflation. They did it anyway because the alternative was admitting the empire was broke. And what happened? Workers refused to accept debased coins at face value. Merchants demanded multiple coins for goods that used to cost one. By 301 AD, Emperor Diocletian had to issue price controls. Maximum prices for everything. Bread, wine, clothing, labor. Because the market wouldn't cooperate. Because when you debase currency, the market reprices. Always. And the people who saw it coming? They didn't hold debased coins. They hoarded old coins with high silver content. They melted down coins and stored pure metal. They paid premiums for physical silver over the debased paper promises the government was issuing. Sound familiar? That's what premiums mean. They mean people don't trust the official price. Don't trust paper promises. We'll pay more for physical possession. Because physical can't be printed, can't be debased, can't be confiscated. Why a ledger entry? It just is. The Roman Empire spent another 175 years slowly dying. Not from barbarian invasions, from monetary collapse. From the moment paper promises and physical reality diverged. From the moment premiums appeared, trust disappeared. That's Act 1, the pattern's first appearance. When paper and physical decouple, when premiums explode, the system is under stress. Terminal stress. March 17, 1968. The London gold pool collapses. For 7 years, the US and 7 other nations tried to suppress gold prices by selling reserves into the market. Keep gold at $35 per ounce. Maintain confidence in the dollar. Show the world that paper money is as good as gold. By 1968, they'd sold over 3,000 tons. The pool was hemorrhaging gold, and it wasn't working. Physical demand overwhelmed paper supply. People wanted real gold, not dollars promising gold. The real thing. So on March 17, the pool closed. The official gold market shut down for 2 weeks. When it reopened, there were 2 prices. The official rate is $35 for central bank transactions. And the free market rate immediately jumped to $42, a premium, $7 for physical over official. Within 3 years, Nixon closed the gold window completely. August 15, 1971. No more gold convertibility. The dollar became pure fiat. And gold, freed from official suppression, went from $35 to $850 by 1980. 24 times. Silver went from $140 to $50. 35 times. The premiums in 1968 were the early warning, the signal that paper and physical were diverging. Those official prices didn't reflect reality, that the system was breaking. And what's happening in Shanghai right now? The same pattern. Physical trading at $8 premiums to futures. The world's largest consumer pays more for immediate delivery than Western markets charge for promises. The decoupling, the divergence, the break. That's Act 2, the modern precedent. When physical premiums explode, when markets fracture between paper and real, monetary systems are approaching collapse. And the assets that preserve wealth are the ones people are paying premiums for. The physical, the tangible, the real. Now let's talk about what happened yesterday. December 24th, 2025, Christmas Eve. While the West was winding down for the holidays, Shanghai's silver market was under stress. The Ag T plus D contract, Shanghai's spot physical silver contract, closed at 19,400 yuan per kilogram. That's $78.55 per ounce in US dollar terms. Meanwhile, COMEX futures in New York settled at $72.36. The premium, $8.19, over 11%, for the same metal, same day. But it gets worse. Shanghai is in backwardation, spot prices exceeding futures prices. That means people want silver now more than they want promises of silver later. That only happens when physical supply is genuinely tight, when people fear they won't be able to get metal in the future at any price. According to reports, lease rates in Shanghai spiked. The cost to borrow physical silver surged as lenders realized the metal they loaned out might not come back. Industrial users are hoarding, solar manufacturers, electronics companies. They're securing multi-year contracts, building strategic reserves, because they've run the numbers. They know the deficit is real, they know inventories are gone, and they know if they don't lock in supply now, their production lines stop. China consumes over 50% of global silver. Solar panels, electric vehicles, electronics, 5G infrastructure, AI data centers, all of it requires silver. And China dominates manufacturing in all those sectors. They're not buying silver to speculate. They're buying silver to survive, to keep factories running, to maintain economic growth. And as of January 1st, China restricted silver exports. Only large state-certified companies producing at least 80 tons annually get licenses. That's 60 to 70% of global refining capacity about to be choked off. The supply valve from east to west is closing, so Shanghai faces a double squeeze. Domestic consumption exceeding domestic production, and export restrictions are preventing imports from filling the gap. The result? Physical silver in Asia is worth more than paper silver in the West, and that premium is growing. But here's what nobody's discussing. What happens when Western industrial users realize Asia is paying $8 more for the same metal? What happens when arbitrageurs start buying COMEX contracts, taking delivery and shipping to Shanghai for $8 profits? What happens when COMEX has to actually deliver physical metal instead of rolling contracts forward? COMEX registered inventory, metal available for immediate delivery, is already at multi-year lows. In early December, 47.6 million ounces were claimed in 4 days. 60% of registered inventory gone. And now there's an $8 arbitrage opportunity pulling metal east. This is how paper markets break. Slowly, then suddenly. Premiums appear, diverge, widen. Arbitrage flows reverse. Physical drains from west to east. And one day, the futures exchange can't deliver. Defaults. And the official price becomes irrelevant because physical trades at whatever premium the market demands. Let me show you why this matters. Why an $8 Shanghai premium isn't just interesting. It's a signal, a warning, a flashing red light that the global silver market is approaching systemic stress. The Silver Institute projects a 95 million ounce deficit in 2025, the fifth consecutive year, cumulative shortfall since 2021, 820 million ounces. Imagine draining an Olympic swimming pool every year for 5 years straight. That's silver inventories. Gone. But deficits don't cause crises alone. Markets can run deficits for years if inventories buffer the gap. The crisis comes when inventories deplete, when the buffer disappears, when current production can't meet current demand and there's nothing left to draw down. That's where we are now. COMEX inventories are down 73% since 2020. Shanghai Futures Exchange inventories were below 500 tons in November. Record lows. The London market is tight. Lease rates are spiking globally, not just Shanghai, everywhere, and demand is accelerating. Solar panel manufacturing consumed 200 million ounces in 2024. That sector is projected to grow by 40% over 3 years. Electric vehicles, AI data centers, electronics, all growing. All consuming silver, all are competing for limited supply. Mine production can't respond. Grew 1% in 2025. 70% of silver comes as a byproduct. You can't just mine more when prices rise. New projects take 7 to 10 years. The Silver Institute forecasts new supply additions of only 44 million ounces over the next 5 to 10 years, against deficits approaching 100 million annually. The math doesn't work, and when math doesn't work, markets reprice violently, until supply and demand reach equilibrium, until price ratios are consumed, until marginal uses get priced out. But we're nowhere near equilibrium, because Shanghai just paid $8 more than COMEX for physical silver. That's not equilibrium, that's stress. That's a market screaming that physical supply doesn't exist at current prices. And here's the critical insight. Premiums don't shrink during shortages, they expand. As stress increases, as supply tightens further, and as more buyers compete for less metal, premiums grow from $8 to 10 to 12 to 15, until Western prices catch up, until COMEX in London reprice to match Shanghai, until the paper market admits physical reality. That's the pattern. That's what happened with gold in 1968, $7 premium in March, complete decoupling by August 1971. 24 times the price increase over the next 9 years. Not because gold changed, because paper promises broke and physical repriced. Shanghai's $8 premium is the 1968 London gold pool moment, the early warning, the signal that paper and physical are diverging. The system is under stress, that Act 3 is accelerating toward Act 4. Now let me show you the full pattern. The 4 acts explain where we are and what's coming. Act 1, monetary debasement. Rome clipped silver from coins. Weimar printed marks. Nixon closed the gold window. Today, global debt sits at $318 trillion, according to the Institute of International Finance. Debt to GDP is 328%. Interest payments consume 15 to 20% of government revenues. The debt trap, where repayment is impossible, so debasement becomes inevitable. Act 2, divergence. Paper and physical prices are split. Premiums appear. In Rome, people paid premiums for old high silver coins over new debased ones. In 1968, gold traded at premiums to official prices. Today, Shanghai trades $8 over COMEX futures. Same pattern, different century, same signal. The paper system is losing credibility. Act 3, the drain. Physical flows from west to east, from paper markets to physical markets, from low premium regions to high premium regions. In 1968, gold drained from London to private buyers. Today, silver is draining from COMEX to Asia. Registered inventory is down 60% in days, arbitrage pulling metal east, the physical leaving the system. Act 4, the break, when paper markets can't deliver, when contracts default. When official prices become irrelevant because physical trades occur at premiums, the official market won't acknowledge it. In 1971, it was closing the gold window, admitting the system couldn't deliver, repricing everything. We're not in Act 4 yet, but we're approaching it. Shanghai's $8 premium, COMEX draining, China is restricting exports, 5 years of deficits, industrial users hoarding, lease rates are spiking, backwardation, all of it, simultaneously. These are Act 3 signals, the drain, the stress, the moment before the break, and what comes after the break. History shows 2 outcomes. Either the paper market admits reality and reprices dramatically higher, or the paper market breaks completely and physical trades in a separate market at whatever price. Supply and demand dictate. Either way, the people holding physical win, because physical can't default, can't break promises, can't fail to deliver. It just is. So what does 78.55 in Shanghai mean practically? What do you do with the information that physical silver is trading $8 over futures? First, understand what premiums signal. They signal distrust of paper, distrust of promises, belief that physical possession is worth more than contract rights. When premiums are small, 1 or 2%, that's normal market friction. When premiums are $8 ONA, $72 silver, over 11%, that's stress, system stress. Second, recognize the arbitrage. If Shanghai pays $8 more, why wouldn't Western buyers take COMEX delivery and ship east? They would. They are. That's why registered inventory is draining. That's why the physical is leaving. And every ounce that leaves makes the next ounce harder to deliver, makes the strain worse, makes the premium wider. Third, consider the end game. Premiums this large don't persist in equilibrium. They either shrink because supply increases, or they expand because Western markets reprice upward to match Shanghai. Given that my supply is flat, given that deficits are structural, given that China restricted exports, which outcome is more likely? History and logic say Western prices catch up. COMEX and London reprice. 72 becomes 80, 80 becomes 90, not because silver changed, because the paper market admits what the physical market already knows. Supply is gone. BNP Paribas says $100 silver is possible. Bank of America's technical team is bullish. UBS forecasting continued strength. Those targets don't look aggressive when Shanghai physical is already at 78 with $8 premiums. But here's what I want you to understand. This isn't about predicting prices. This is about recognizing patterns. Shanghai's premium is the 1968 gold premium, the early warning, the signal that paper and physical are diverging. The system is under stress. In 1968, gold's $7 premium preceded a 9-year bull market where gold went up 24 times. In 2025, silver's $8 premium in Shanghai is preceding what? We don't know yet, but the pattern suggests something significant. Think of premiums like cracks in a dam. Small cracks are manageable. Large cracks are a warning. $8 cracks on a $72 asset? That's 11% of the price in premium. That's a structural issue. That's the dam under stress. And the response? If you trust paper promises, you ignore premiums. If you understand the pattern, you pay attention. Not to panic, not to speculate, but to recognize that when the world's largest consumer is paying 11% premiums for physical delivery, supply is tighter than official prices admit. Silver is up 149% year to date. Shanghai Physical at 78.55. COMEX futures at 72.36. The gap is widening. The stress is increasing. Act 3 executing. Act 4 is approaching. Let me be direct about risk. Premiums can disappear. If supply suddenly increases, if demand suddenly drops, premiums shrink. Shanghai could reprice lower. COMEX could reprice higher. The gap could close without Western markets moving up. But betting on that requires believing my production will surge, that industrial demand will collapse, China will reverse export restrictions, that solar and EV growth will stop. Those 5 years of consecutive deficits will suddenly become a surplus. Possible? Sure? Probable? History says no. Structural deficits don't fix themselves quickly. Markets in backwardation don't relax without pain. Premiums this large don't shrink without one side repricing. The other risk is intervention. Governments could change the rules. In 1980, COMEX banned new silver purchases to crush the rally. Could that happen again? Possible. But harder this time. Because the rally isn't speculative. It's industrial users securing supply. It's structural deficits meeting tight inventories. You can't ban industrial users from buying inputs they need to manufacture. So the risks are real. But the pattern is also real. And the pattern says that when physical trades at significant premiums to paper, when the world's largest consumer pays $8 more for immediate delivery, when markets are in backwardation with spiking lease rates, the system is approaching a break. Not tomorrow, maybe not next month, but approaching. And when the break comes, the people holding physical wins, because physical is what everyone suddenly wants. And premiums are what everyone suddenly pays. Remember Rome? Premiums for old high silver coins. Remember 1968? Premiums for physical gold. Same pattern, same signal, same outcome. TT paper broke. Physical repriced. Shanghai just paid 78.55. COMEX settled at 72.36. That's not a rally. That's a fracture. That's the global silver market splitting between paper promises and physical reality. And when that happens, when markets fracture, history says the side that gets repriced is paper. Always. So where does this leave us? What does an $8 Shanghai premium mean for the next 6 months? The next year? It means Act 3 is executing. The drain, the stress, physical flowing east, inventories depleting, premiums expanding, industrial users hoarding, all the signals that precede Act 4. The break. It means the paper market is losing credibility. When the world's largest consumer won't accept futures prices, when they pay 11% premiums for physical, they're voting with money. And their vote says COMEX doesn't reflect reality anymore. It means Western markets will face a choice. Reprice upward to match Shanghai, or watch all physical drain east, watch registered inventory hit zero, watch the exchange face delivery failures, one or the other. No middle ground. And it means investors have a window, a brief moment where the pattern is visible, but the repricing hasn't happened yet, where Shanghai knows, but New York doesn't, where physical trades at 78T, but futures settle at 72. That gap is the opportunity and the risk. BNP Paribas, Bank of America, UBS, they all see it. $100 silver isn't crazy when physical's already at 78 in the largest consumer market. It's math. It's arbitrage. It's the premium expanding until Western markets admit reality. So ask yourself, can you see the pattern? Can you see why an $8 premium isn't just interesting data? It's a signal, a warning, a replication of 1968 gold. The moment before the system admits it can't deliver. The moment before paper and physical definitively decouple. Drop a comment. Tell me what you think happens next. Does COMEX reprice to match Shanghai? Does the premium shrink? Or does this fracture widen until something breaks? And if you want to understand what happened after the 1968 London gold pool collapse, how premiums evolved, how long it took for the system to break, hit subscribe. Because next week I'm breaking down 1968 to 71, the 3 years of divergence, the signals before Nixon closed the gold window, and what it teaches us about recognizing Act 3 before Act 4. Shanghai just paid 78.55 for physical silver. COMEX settled at 72.36, an $8 premium, 11% for the same metal, same day. That's not a price, that's a message. The message is clear. Physical and paper are diverging. The system is under stress. Act 3 is executing. And Act 4, the break, the repricing, the moment when paper admits it can't deliver, that's coming. The pattern doesn't care if you believe it. It doesn't care about your politics or your economic theories. It just executes. And right now, it's executing exactly as it did in Rome, exactly as it did in 1968. The paper is losing credibility, physical commanding premiums. The drain begins. The break is approaching. The only question is whether you see it.